Want to see a couple more words?
Testing the audio right now. See if we have it back here.
Change that, see if that works.
We're testing the audio right now, checking to see if it works. Testing. Hello. Testing. Hello.
Okay. You want to start from the top?
All right, looks like we have our audio situation figured out. I'll go ahead and start from the top again. Good morning and welcome to the March 2025 Director's Cut. Thank you to everyone that is joining both online and in person. I want to thank the team at the DMR for their great work and efforts both in the field and the office during the legislative session. There have been numerous bills that the agency has worked on, and it has truly taken a team effort to tackle this session. The Director's Cut will look quite different this month. We have tried to capture all of the same data as in the past, but in a presentation format. We have completed about 90% of what we wanted to through the redesign, so there will be a few more slides to come in the future. We hope you find the new format helpful. If you have questions, please reach out. With that, we will dig into the data. I'll note that the March Director's Cut will cover production numbers from January 2025. Slides. We'll get started with North Dakota production. You can see on the graph on the left is our the red line is our gas line in BCF per day. The black line is your oil, your North Dakota oil line, and the green line is your Bakken Three Forks oil. In the upper right-hand corner, you'll see the statewide production. The Bakken historically has been at 97% of the state production. Currently, it's at 98%. Oil production in January was at 36,340,859 barrels, or 1.172 million barrels per day. December production was 36,959,684 barrels, or 1.192 million barrels per day. This is 6.6% above the revenue forecast of 1.1 million barrels, but it is 1.7% down from December into January. So roughly 20,000 barrels per day, December to January decline. We attribute that to a cold spell in mid-January, slightly less completions that you'll see in a future slide, and then I would expect February, due to its very cold temperatures, to have similar results. Moving down to gas production, January was at 103.1 BCF, or 3.3 BCF per day. December was at 104.7 BCF, or 3.4 BCF per day. Again, a slight reduction in gas month over month. This next slide we added due to some questions that we've had on recent county production. This is North Dakota production by the top 10 oil producing counties. On the left y-axis, you'll have oil production in millions of barrels. That's the big blue bars that are on the graph. The top oil producing county in the state is McKenzie at 10.9 million barrels for the month, followed by Dunn, Montreal, Williams, and Divide. The black dots represent the percent of the state's total production, and you'll notice that again 30% of the production in North Dakota on a daily and monthly basis comes from McKenzie County. The next is rig counts by basin. The data is the source of the data is Baker Hughes. The North Dakota number is off the DMR daily report. You'll see that the total rig count in the United States is at 592. 47% of those rigs are in Texas, and the North Dakota count currently is at 32. The trend is consistent with that of January at 32. December had 36, and we spoke in prior director's cuts about that slight decline in rig count. The graph on the bottom represents the rig count by basin. You'll notice 34 total rigs in the Williston Basin, 301 rigs in the Permian Basin. That's both the Texas and New Mexico side. So roughly 51% of the total U.S. rig count is in the Permian. We'll also note that there's 25 rigs or 35 rigs in the Northeast United States, both the Marcellus and Utica dry gas play. Following slide is really meant to track North Dakota activity levels relative to prices and identify trends. The top graph shows your North Dakota oil price in the green bar, the WTI in the blue bar, and your Henry Hub gas price in red. Current WTI oil is right around $68. Current Henry Hub gas price is right around $4. The North Dakota oil price for January came in at $67.64, 3.4% low to the revenue forecast of $70. Current frac crew count on the bottom is at 12, and that's consistent with both January and February. Rig count remains at, like I said, the 32 to 33 rig count for the month. Moving on to permits and completions, you'll see this graph has wells permitted in the blue line, wells completed in green, and wells waiting on completion in red. The trend continues to be consistent with completion trends for February at 79. January was at 78, and December was 89. Permits relatively consistent, 90 for the month of February, 102 for January. So really a consistent trend between 80 and 90 over the past 3 months on completions. Note that this is where I want to highlight that we had 78 completions in January and 89 in December. So the slight reduction in completions could be what accounts for that slight reduction in oil production in the state. The next slide is our total producing well count. That stands at 19,059. Inactive wells in red is at 1,628. The total producing wells is down slightly due to offset completion activity. And the number of inactive wells steady between 1,400 and 2,000, typical to be a highly variable number. Moving on to Fort Berthold activity, you'll see that January production is a highlight, and that's up slightly at 163,986 barrels. The rig count remains steady at 2. The total active permits on the bottom remains steady at 126, and the number of active wells stands at 2,956. So I guess the highlight on Fort Berthold is there must have been some completion activity in the month, which increased production. So that's a positive. Moving on to gas capture, the statewide, you'll see the gas capture details in the lower left-hand corner. The statewide number remains strong at 95. The statewide gas flared volume for December to January decreased by 17.1 million standard cubic feet a day to 177 million standard cubic feet. The following slide is this is our last slide. It's really meant to be a summary slide for those of you that like these numbers in this format. I won't cover all of the details, but it's available if you'd like. In summary, we're seeing a steady rig count and steady completion activity in 2025 so far, which was expected after the slight reduction in activity from 2024 to 2025. Similar to the rig and completion crew counts, production has remained relatively steady with a very slight reduction of about 20,000 barrels of oil per day, and we expect that to be the case for the majority of 2025, barring any major swings in oil prices. Like I mentioned, I would expect February. We don't have any numbers in, but I would expect February to be consistent with that in lieu of the really cold temperatures that the state experienced. As I've spoke about during the last couple sessions, the trend to longer horizontal laterals continues to the 3 and 4 mile lateral lengths. We are still putting the final touches on the data, and I do expect this data to be a slide in the coming months. Director's cut. In closing, we seem to be in steady state relative to production the last few months. Pricing has been generally steady in spite of numerous non-supply and demand related items affecting short-term pricing. I certainly think that as some time passes with the current administration in office, that we will have a better idea of where prices land, but I do expect a softer oil price environment than what we saw in 2024. That concludes my report, and I will turn it over to Justin Kringstad with the North Dakota Pipeline Authority for his update. Any questions?
So you weren't surprised by the Moody's and S&P global predictions for oil prices?
Yeah, I just think, no, I was not surprised by, the slight reduction in forecasts coming out of those groups. I think there's a lot of noise in the system right now. There's still wars going on. There's no ceasefire with Ukraine and Russia. Just, there's a lot of supply in the system. I think the Trump administration is doing things with tariffs and sanctions, and there's a lot of movement occurring right now. So I'm not surprised by the slightly lower oil price. I don't expect it to drop through the floor, but we have the SPR is still out there. I would think that if prices dip low enough, the federal government might consider increasing input into that, and that would probably set the floor for oil price, and then we'd work up from there. Would be what I would expect, but not surprised by slightly lower forecast.
I want to follow up. There's a bill pending in the legislature. I'm not exactly sure if it's come to a final vote yet, to provide some incentive for drilling outside the Bakken.
Mm-hmm.
And my question I'm kind of wondering is, what's the opportunity outside the Bakken?
Mm-hmm.
Is there a lot of oil out there?
Yeah, the DMR testified on that bill, and I believe there's 18 different producing formations that have produced oil in North Dakota. And right now, like I mentioned, we have 98% of the oil production coming out of the Bakken Three Forks. I think that bill is really meant to try to incentivize production outside of that. And I would say that it may appear at first glance that the state would be giving up a tax revenue there, but right now no companies are really out exploring other formations. So I actually look at that particular bill as an opportunity to gain more data and insight and more production outside the Bakken Three Forks formation. So right now the tax revenue coming in from that is at zero, very low. I think we have 30,000 barrels or somewhere in that range of production coming from non-Bakken Three Forks related.
He said that he would like to see some companies try horizontal drilling in these conventional fields.
Yeah, I think the one that comes to mind, when I look at the maps of the Mission Canyon, there's plenty of horizontal 1 mile wells that are in the Mission Canyon, but I think there's other intervals deeper that there's opportunity in, and I just think that particular bill. I think is really just meant to kind of help incentivize exploration outside of the Bakken Three Forks. I think companies have gotten very disciplined financially and fiscally, and just churning out rates of return and free cash flow to investors. And the challenge is how does a state like North Dakota try to continue to promote additional production within the existing rock column that's there. So.
Thank you.
Thank you. With that, any other questions? With that, I'll turn it over to Justin.
Good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get right into some production updates. That's the lone data point on the second slide that you heard from Nathan. Slide 3, just taking a look at an update from around the region. Continue to see some increases on that eastern Montana portion of the play. They saw about a 30+% increase here so far in 2024. They've got 2 active drilling rigs over there, so we'll keep an eye on that. Again, that is part of the transportation network that we monitor. Both oil and natural gas share that system with North Dakota, and so we're always keeping a close eye on what our neighbors are doing and how that's influencing the broader system. The month-over-month changes, again, this is just the historical context for the oil and gas side, but then on the bottom, the GOR that we're looking at steady from December to January, so no major surprises there. The trend continues on that upward movement as expected. Just some minor shifts on the movement. Again, we didn't see a major production shift. There weren't really any major market events taking place that were going to alter meaningfully the the oil movement directions. We're still seeing that Brent WTI spread sub $5, so we're not seeing a real strong incentive for elective barrels to get onto the rail network versus some of the traditional pipeline options out of the basin. So fairly steady on that front. Still right around, give or take, 2 unit trains per day loaded leaving the basin somewhere in that 120, 125,000 barrel per day range is the best estimate we have at this time. When we look at the movements, this is again some additional data coming from the Federal Department of Energy. Majority of that continues to be to the Pacific Northwest. And so I anticipate, we'll see coming up here as we start to get towards the February, March, April data. It'll be interesting to see if the tariffs and any restructuring fundamentally starts to happen. So, but this month, next month, I don't anticipate any major changes, but we'll certainly keep a close eye on that. Pad 5 up in the Pacific Northwest. Typically Pad 1, if you've been watching these long enough, typically is some of the strongest oil pricing. We've seen that shift now to that Pad 5 area. So really, it's significantly more attractive on a rail barrel. It's a shorter haul. It's a one carrier haul to that Pacific Northwest, and with broader, higher oil prices in that region, certainly no mistake that it's 90+% of the oil heading that direction. When we look at pricing, as of the last couple of days here, still seeing a negative pricing in that Clearbrook market. So that premium that we were seeing over the last couple of years has gone away. I'll quickly note, Nathan had it included in his as well, that North Dakota oil price in January of 67.64. That discount to WTI, that major benchmark, at $7.61. And so that is the highest spread that we've seen since the 2020 timeframe. So that was higher than I had anticipated. I know on the budgeting forecast planning somewhere in that 6 to 650 range. I'm hopeful that was a market anomaly and that we can start seeing some narrowing of that spread. Certainly for every dollar that North Dakota's barrel of oil is discounted at today's production, today's tax rates, it's about $40 million per year. So every dollar is incredibly meaningful in that state budgeting process. It's meaningful to the royalty owners, the producers, and obviously the state of North Dakota as a major stakeholder there as well. So we'll keep an eye on that and keep everyone up to date. Moving into some of the imports, exports, again, just some minor changes there. Again, this is one of those things that for marketing reasons, there's not a lot of color available publicly on how these decisions are being made. Again, as we get into those later months here with the tariff situation, we'll see if we see any data trend movements. On the natural gas side, continuing that 5% flaring, 4% from wells connected to a gas gathering system, 1% from those unconnected facilities. So no change December to January on that front. And then just a historical context, really hovering and staying pretty solid in that 4 to 5% flaring, which is certainly encouraging and is over the DMR requirements of gas capture. We're seeing more wells in January getting connected to gas sales than the new wells producing gas. So that was, again, an encouraging signal that the companies are out there getting connections done in a very timely manner. The EIA did up, if you recall last month, the EIA had taken a haircut off of some of their price outlooks. They've increased it slightly, another couple bucks here in March. At the bottom right-hand corner, that's their balance on a world production, world consumption. They're anticipating a little bit narrower band between production and consumption. So that surplus that they were previously forecasting, a lot of that has eroded here in their March outlook. No major announcements to talk about today on the gas processing side. And so we'll transition then into just some of the broader current market snapshot of what's taking place. So right around 80% market share on the Northern Border Pipeline. That's again our major export system for our residue natural gas out of the basin. That you will look at the trend and think that that looks a little bit softer. I'll quickly point to slide 21 and say we have been seeing some chemistry changes taking place on the pipeline itself. So anytime you start seeing a drying out, a lowering of that BTU number in the Northern Border system, that frees up space. And so some of that market share percentage is certainly being influenced by what we're seeing on decisions at gas processors on what they're doing, particularly with the ethane molecules and whether or not those go into an NGL pipeline or in the cases where you see a higher BTU, those NGL barrels are getting tucked in with the residue stream, and we're seeing a pullback from that, which does free up space, which is, again, an important thing to consider when we look at some of our longer term needs. The Bakken East project that we've talked about, as well as the Intensity Infrastructure Partners, both of those open seasons have wrapped up. There is nothing that I can share at this time about the results of that. I will just say broadly, there's continues to be encouraging developments and interest in new pipeline infrastructure, but it's going to be a little bit more time before we have any real clarity to share of what the infrastructure systems will look like here going forward. So stay tuned on that. And then I think that's it for that I have for formal remarks, but I'd be glad to answer any questions if there are any. Nothing online. Okay, well, thank you very much.
You don't have anything to share.
Yeah.